afternoon to all. In this session, we are going to see an introduction of company accounts, that is issue of share capital. So before we go into some, so we just see the important terms and meaning of share and the important terms which we used in the connection with the issue of share capital. So this is the meaning of shares. Share capital constitutes the basis of the capital structure of the company. So it extends the ownership of the company and invested to the shareholders, and it represents the extent of the ownership and interest in the assets and profits of the company. And also it is defined as one of the equal parts into which the capital of a company is divided, entitling the holder of the share to a proportion of the profits. So actually this is the meaning of shares. So next we are going to see some of the important terms which we are using in the issue of share capital. First one is authorized capital. Authorized capital is nothing but registered capital. It is the amount of capital clause of memorandum. It is the maximum amount which the company can issue during its lifetime of the business, but it's shown in the liability side of the balance sheet without adding in the amount. For example, see, there is an example is there, rupees 10 lakhs divided into 1 lakh shares of rupees 10 each. So these 1 lakh is the authorized capital. So it will offer to the public at the lifetime of the business. So next we are going to see next division, that is authorized capital is the first registered capital, then it will divided into again two, that is issued capital, unissued capital. Issued capital is the part of authorized capital which offered to the public. So as per our example, authorized capital is 1 lakh, but at the time of issued capital, they can issue only 80,000. So this is called as issued capital, and next one is unissued capital. It is the difference between authorized and issued capital. So as per our example, authorized capital is the 1 lakh shares, but at the time of issued, they are offered, the company offered only 80,000 shares. The remaining amount 20,000 is the unissued capital. And next one is subscribed capital. What is meant by subscribed capital? It is the part of the issued capital which is subscribed by the public. So already we offered 80,000 shares, but at the time of subscription, they can offer only 60,000 shares. And then subscribed capital. So these 60,000 will offer to the public at the rupees of 10 rupees each. But at the unsubscribed capital, it is the difference between, see, issued capital is 80,000 and subscribed capital is 60,000. So the remaining capital 20,000 shares are unsubscribed capital, and next one is called up capital. So this called up and uncalled up capital. Called up capital, it is the part of subscribed capital which is the shareholders are called upon by the company to pay. So 50,000 shares. So subscribed is 60,000, but called up capital at the time of called up, they can issue 50,000 shares instead of 60,000. They can issue 50,000 shares at rupees 10 each. But actually, at the time of paid up called up capital, the company offered only 6 rupees. This is called a called up capital. Called up capital. And next one is uncalled up capital. What is meant by uncalled up capital is the difference between the subscribed and uncalled up capital. So already they can issue the public that is 50,000 shares of rupees 10 each, that is 6 rupees. At the time of called up capital, they can issue 6 rupees. But at the time of the difference between called up and subscribed capital. See the example is there is a subscribed is rupees 10 each actually. So 80,000 shares of rupees 10 each. But at the time of called up, they can call only 6 rupees, that is 50,000 into 6, 3 lakhs. So uncalled up capital is the difference between called up capital and subscribed capital. That is 4 rupees is the uncalled up capital. It can be offered later to the public. And next one is paid up. So paid up means after called up the capital, the shareholders have to pay the actual amount. That is, it is the portion of the called up capital which the shareholders are actually paid. And next one is false in arrears. Some of the shareholders have not or failed to pay some of the amount, that is rupees 2 per share. For example, some shareholder is having 2,000 shares. So that shareholder failed to pay rupees 2. That means rupees 4,000 have to pay, but they won't pay. That is called as calls in arrear. And next one is reserve capital. Reserve capital means that unissued capital is transferred into reserve capital. That is, it is a part of capital which is not issued and can be issued only at the time of winding up of the company, is known as reserve capital. And next we are going to see a method of issue of shares. So usually the company use two methods, that is for the consideration of other than cash and for the consideration of cash or installment basis. Usually the company can offer this second method because this first method is used only at the situations when they occur. If they are acquisition of assets, or if they are issue of shares at vendor of the business, or if the issue of shares to promoters, at that time only the first method will be followed. Usually the company followed the second method, that is for the consideration of cash or installment basis, that is on application, on allotment, or first, second or final call. So next we are going to see some of the model entries of issue of share capital. So model entry is, this is the standard journal entry which we have to use at the time of solving the problem of issue of share capital. So first one is application money received, that is bank account data to share application account, and then immediately the share application money is transferred to share capital, that is share application account data to share capital account. And third one is rejection. If the company offered 20,000 shares but they received 25,000 shares, means the company directors can rejected the some for excess shares. So that we can use this journal entry, share application account data to bank account. This is the rejection entry. This rejection entry is when the directors rejected some of the shares. At that time only these journal entries we have to write. And then share allotment money due. This is the next installment basis. Actually 3 installment basis. First one is application received, the second one is allotment. So this is the second installment basis. First we have to create a money due, share allotment money due. Share allotment account data to share capital account. So being the share allotment money due. And then first we have to create a due entry, then we have to create a received entry. Bank account data to share allotment account, and so at that allotment time we have to create discount and premium. If the company issued a shares at discount, or else it issued a shares at premium, means we have to adjust it into allotment basis. So share allotment account data, discount on issue of share accounts data to share capital account, being issue of discount on the allotment. And next one is premium. So discount and premium, so it should be mentioned in the problem. So if they are not mentioning, means we didn't prepare this journal entry. So share allotment account data to share capital to share premium, being issued at premium on the allotment. Next one is first call money due. Whatever it may be, we have to create first call money due entry, then only we have to create a received entry. So share first call account data to share capital account. So same entry for share second call account data to share capital, and also if there is any final call, means so we have to prepare share final call account data to share capital account. This is the first call money due. And next one is first call money received. So bank account data to first call account, being share first call money received. So same entry follows for second call money due and second call money received. And next one is forfeiture. What is meant by forfeiture? Forfeiture means the termination of shares. Some of the shareholders or fail to pay an allotment, or else if there is any first call, or else if there is any second call. So at that time the company terminate the shares and also cancel the ownership of the shareholders. At that time we have to create a forfeiture entry. share capital account debtor, to discount on issue of share account, to share first call, to share second call, on to share forfeiture account, being share forfeiture account. And so after we have to create a forfeiture, the company can reissue that forfeited entry. So some of the shareholders are not paid allotment account or else or allotment money or else first call or second call, means at that time that particular shares will be reissued to the public, whether it is a par value or it is a premium or it is a discount. So the entry is bank account debtor, forfeiture account debtor, to share capital account. And again, forfeiture account is transferred to capital reserve, share forfeiture account debtor, to share capital reserve account, being share issued to transfer to capital reserve. First we have to create a forfeiture entry, then if there is any reissued, means we have to create a reissued entry, then only we can transfer to capital reserve. So these three entries are based on the forfeiture entry. Forfeiture means, again I will explain, termination of shares. So now we are going to see some of the issue of share capital. So in this sum, Rajan Limited issued prospectus inviting application for 20,000 equity shares of ₹100 each, and each as payable as follows, means ₹25 on application, 25 on allotment and 40 for first call. So they received 25,000 shares were applied, but the directors accepted only 20,000 shares, and balance 5,000 shares will be rejected. Remaining applications, all money due were fully received. Give necessary journal entries. So in this slide, I have to explain the described manner of the question. So working notes, total shares issued 20,000. The company offered 20,000 shares, and the total shares received, the company received 25,000 shares. So total shares is 25,000, but the company need only 20,000 shares. So rejected shares is 5,000. So application money, allotment and first call. See, this is the problem. So next we have to prepare a journal entries, that is share bank account debtor to application money. First entry is application money received, and then application money transferred to share capital. So first entry is application money received, bank account debtor to application account, and then share application money transferred to share capital, share application account debtor to share capital, and then application money rejected. In this sum, 5,000 shares were rejected. So 5,000 shares were rejected. So we have to create a rejected entry, that is share application account debtor to bank account. This 25 rupees will return to the shareholders. So fourth one is allotment. Share allotment account debtor to share capital. So allotment money is 35,000. So we have to give out 35,000. 20,000 into 35, 7 lakhs. And then we have, this is the due entry and this is the receipt entry. This is the standard format. So first we have to prepare a due entry and then we have to prepare a receipt entry. Next one is receipt. It will transfer to the bank. Bank account debtor to share allotment account. And this is the last one. In this sum, there is only the first call itself. So we will close the sum under first call. So first one is first call money due. Share first call account debtor to share capital, and then bank account debtor to first call account. So first we have to create first call money due, then we have to create a first call money received. Thank you.